All right, in this video, we'll look at the highlights of the ratio analysis between McDonald's and Johnson & Johnson over the period 2012-2016. Now, in addition to comparing the two companies, we also want to track numbers over time. And one thing that leaps out, if you're looking at McDonald's current ratio, which is current assets divided by current liabilities, a measure of liquidity. The current assets are money coming in, current liabilities are money going out. We can see that there was an aberrant year here in 2005 for McDonald's. Now, the current ratio, which is current assets over current liabilities, could have a big leap in that year for two reasons. One, the current liabilities could have stayed roughly the same and the current assets could have jumped up. The other would be the current assets stay the same and the current liabilities drop down. So it could have been either the denominator or the numerator. When you see a big change like this, first thing you do is go look to see why. And we can see why here. With McDonald's, the net receivables are the same. Most of these other numbers, the inventory is negligible anyway. Other current assets, you don't see a lot of changes, but you see a $5 billion leap up here in cash for the year. Now, since the balance sheet's on a particular day, this might have been just the day they had a bunch of cash parked in there. They were doing share buybacks and stuff like that. You need cash to actually do the transaction. So this just could have been the particular day we were looking at as opposed to a change. But you don't know that until you get in there and start digging around and trying to figure out why the change occurred. If we go down here and look at the cash ratio, that is the ratio of cash to current liabilities, and I think that's a more plausible test of liquidity. Look at Johnson & Johnson. This ratio is over 1. They have a lot of cash available to pay any of their current liabilities. Cash is the most liquid of the current assets. So that's what the cash ratio, which is cash over current liabilities, that's what that's measuring, is probably the strongest test of liquidity there is. The quick ratio is current assets minus the inventory, because inventory is often considered not as liquid. So what we see here is there's almost no difference here between McDonald's current asset and quick ratio. So the omission of inventory means nothing, and that's because McDonald's has virtually no inventory on their balance sheet. $31 billion of assets and $59 million of inventory. If we look over here at Johnson & Johnson, you'll see a bigger drop in the quick ratio because they do hold a fair amount of inventory. But again, they're still highly liquid no matter how you measure it. So we go down here into the asset management ratios, the turnover ratios. Accounts receivable turnover is sales per dollar of accounts receivable. And another measure of that is days of accounts receivable, which is essentially accounts receivable divided by 1 day's sales. So when 1 day's sales is sales over 365. So this says that about 21 days elapse on average between when somebody buys something and when somebody pays for it. And you see that it's roughly 2 to 3 weeks for McDonald's, and for JNJ it's 60 days. Now those current assets have to be funded. All right, remember, assets have to be equal to liabilities and equity, so liabilities and equity are what you use to fund the working capital here. So having a lot of accounts receivable is one of those things that if you can trim that down, it frees up capital to use for other things. All right, but on the other hand, this might be just a reflection of a much different business model between J&J and McDonald's. The inventory turnover is either sales over inventory or cost of goods sold over inventory. But either way you look at it, McDonald's is materially higher. It's because they hold so little inventory. The days of inventory, which would be inventory divided by 1 day's cost of goods sold, tells you that they only hold a couple of days of inventory at any one point in time. Whereas in contrast, you see J&J is holding, what is that, 4.5 months worth? So materially different approach to inventory. McDonald's very heavy into the just-in-time inventory, and J&J is not. Neither one's better or worse. They're different. All right. So if we're looking at comparable companies, if I was looking at McDonald's compared to Wendy's, that would tell me a different story. Those are two companies that are in the same business, and if we saw them operating vastly different inventory handling procedures, that'd tell me something different. And here it's just telling me that that's the way that the J&J model works, and the McDonald's model is very different. Also, if we look at fixed asset turnover, sales per dollar of fixed assets, it's about 1-to-1 for McDonald's, and for J&J it's about 4.5-to-1. McDonald's owns a bunch of those restaurants, or the land and or building of restaurants, and that fixed assets, the net property, plant, and equipment, is a material part of their balance sheet. With Johnson & Johnson, less so. A lot more of their assets are intangible assets. The total asset turnover is sales per dollar of assets, and it measures efficiency in generating sales with the assets you have. And while we see it's lower over here for Johnson & Johnson, we also got to temper that with recognizing that Johnson & Johnson's assets are not all physical hard assets. You know, so having a patent on a drug is different than is a different value proposition than owning the land that a McDonald's restaurant is sitting on. We also look at the days of accounts payable. It's not actually asset management in the truest sense, because accounts payable are a liability, but we buy inventory typically with accounts payable, and we could see that accounts payable for McDonald's is relatively high relative to the inventory. So whatever their accounts payable is, very, very different than what we see for the inventory. So about 20 days here, and for Johnson & Johnson, again, it's just like with the inventory, it is actually over 3 months, is closer to 4 months for them, which the accounts payable help to fund the inventory and the accounts receivable. So we see a big difference in these two firms in the liquidity and the asset management.